In this video I'm going to explain the concept of net present value. Now a lot of people understand how to calculate net present value but don't necessarily fully understand exactly what they're doing or why they're doing it. So this video is going to focus exclusively on the concept. So here's two choices. We could either pay back our mortgage, which will earn us 4.5%, or we can put that money in a bank account and we'll earn 2%. Now intuitively it's very obvious that it's far better to pay off the mortgage at 4.5% than to earn 2% in the bank account. This is a very simple idea, and net present value is a more rigorous way of showing why this choice is preferable to this choice. So essentially what we're doing is we're using this as a benchmark against which we can judge investments. We're saying if we can make more paying off our mortgage, why are we going to take risk or choose another investment when we know that we can get this rate? So what we're saying here is the net present value when this thing, this 4.5%, is taken as what's called the discount rate. So we're discounting at 4.5% the returns of this. Well, that's going to give us a negative result, so it's going to be less than zero. So when net present value is negative, what's that telling you? Well, it tells you that that investment is no good, that doing this would be better than doing that. Often the discount rate is used as a measure of risk. So you're saying that in order to take this risk, I want to expect a certain return, and if you don't get that return, you're not going to take that risk. So you could use a different discount rate. For example, in mining, as we'll see, 8% is kind of a standard. But if you're in a really risky area, you might take the discount rate to be 12%. Okay, so let's move on and look at a more specific case. So let's imagine that you want to pay $1,000 off the mortgage, and that's 4.5%. And the other choice is you can invest $1,000 and you would get the following cash flows. So you get $15 first year, $40 in second year, and then you get $1,000 back, your original investment, plus $80 as a final interest payment. It's not as obvious to see which one of these is better. This is why we have things like net present value to do these calculations. So we're going to take this as like our baseline. So we're going to say this is the return that we want. If we get less than this, we're not interested. So we're going to discount these cash flows at this rate. And to do this, you've got this big formula here. So it's a summation. So you start at t equals 0, then you go 1, 2, 3, and just count up. There's 3 years here, so this is going up to 3, which is the n at the top. And we take the cash flow at time t, so that's 0, 1, 2, 3. That goes in there. And we do 1 plus the interest rate. This is as a decimal. And we raise that to the power of the year. So first year, second year, third year, 0th year. So this is what we get when we expand it. You'll see the pattern here. So we've got minus 1,000, because this to the power of 0 is just 1. So we get minus 1,000. You see the cash flow convention, money going away from you is negative, money coming to you is positive. Quite intuitive. Second term here plus the first year, 1 plus the interest rate to the power 1. Then the second year, 1 plus the interest rate to the power 2, and then the third year, 1 plus the interest rate to the power 3. And when we do all this, we get the answer that the net present value for this investment at this rate is minus $2.63. It's negative, therefore this is not a good idea, we shouldn't do this. So this investment is better than this investment. Now let's look at a more concrete example of something you might see in the real world. So we've got a mining company, and here's 3 options for the mine plan. You can go for a high grading approach, where you try and go to the best grade as quickly as possible. A balanced approach that tries to optimize what grade you go for. For example, you don't want to have to go cutting through huge amounts of rock to get to the good stuff. There might be a better approach to get to that body. So let's try to work out what the optimal way is. And the basic approach is just to dig the hole in the order that the rock comes out. Just dig down the way and expand the sides. However, the mine would naturally progress if you were just digging it as a big hole. And the interesting thing is if we add up all these cash flows and subtract the investment, so just add them all up, you see this one's 18.1, this is 17.5, this is 16.5. Hence, this one looks like the best. We think, yep, let's do this one. Well, actually, it's important what order the money comes in. You see, in this case, you're getting 2.1 million. Perhaps you have to cut through a huge bit of rock, slightly more expensive, but the next year you get the juiciest payment. Whereas in the balanced approach, you're making money straight away, and in the normal approach, you're losing money in the first year. You're getting a negative net cash flow. And when you take into account the concept of net present value, you can see that these options, though there's not massive difference in the total cash, there's actually a huge difference in the net present value. So actually this approach is better. This is 14.65 million, this is 14.38 million, so this one's the best. Because you see, this mining company could pay a much bigger dividend here, and the investors could probably earn 8% on that money. So they would quite like the money now, and they can invest at 8%. You see, this is the concept of time value of money. It's better to have money now than money in a few years. If you're going to wait a few years, you're going to expect more money to make up for the fact that you could have been investing the money you were paid in year 1 rather than having to wait till year 5. So you're going to demand what you could have potentially made on that money in order for you to wait for the money. So this really illustrates why net present value is actually used, because just looking at it isn't as obvious. So hopefully this video has been helpful to you and you now understand the concept of net present value rather than just brainlessly calculating it. And finally, thank you for watching.